Hey guys, it's Sasha. US inflation data just came in, and according to CNBC, it is hotter than expected because you see the overall inflation number is at 2.4%. So right now inflation is at 2.4%, but last month it was 2.5% and the month before it was at 2.9%. So obviously if you look at those numbers, dropping down to 2.4% is horrific news according to the media. Apparently some Tweedledums on Wall Street told Dow Jones then inflation should have only gone up 0.1% in September. But the reality is that the overall number is only higher than this expectation in September is because of food inflation, which ticked up 0.4%. And we already knew that food inflation was going to be hot because throughout the last month, data on food inflation was creeping up. Food has a weight of 13.4% of total inflation. So food going up 0.4% in the month means that the month-to-month number has added more than 0.05% to the overall number, which would be 0.1% rounded up. And if you look at the Federal Reserve Bank of St. Louis data, the more accurate version of the month-on-month inflation is 0.16%. It got rounded up to 0.2% in the published data. So if food inflation was not 0.4% in the month, then inflation overall would indeed have only gone up 0.1% as expected. And if you look down the detailed list, the big culprit appears to be eggs. Eggs went up 10% in 1 month in September for a total annual inflation rate of 39.6%. I hope you continue to appreciate the monthly dose of excellent analysis of inflation data here. But going back to the overall inflation numbers, shelter went up 0.2% month on month, which means that shelter inflation has now dipped below the 5% mark for the first time since March 2022. So last month the newspapers were panicking because shelter ticked up. Oh my god, inflation is going to go back up, and I was explaining here how all the data shows that long term that is just a blip in the data. Well, this month that panic has expired, and now we should all be worried about food inflation that has now also had a blip. The truth is, rental prices in the US fell to around 0% inflation over a year ago and have stayed there before reverting to around the 2% mark in the last few months. But rent of primary residence in the inflation data is still showing 4.8% annual inflation and a 0.4% increase month on month because of the lag effect. Tons of rental data out there all points to the same thing. So the shelter component of inflation will continue moving down in the coming months because it has to catch up with what has already happened in the real world in terms of price movements. Owner's equivalent of residences is also still high at 5.2%, but house prices haven't moved in over 2 years. Rates are now starting to come down. Rental prices are down, and that number is derived from rental prices or quasi-rental prices. But going back to the detailed shelter data, look at this bit here. Other lodging away from home, including hotels and motels, down 3.7% year on year and down 4.7% month on month. Now the last column is the adjusted version because September does come on the back of summer vacations. You would expect a drop in prices, but even the adjusted number is minus 2.3% month on month for September. And when you look closely, this trend continues throughout all non-essential spending. After being negative every month, new vehicles are plus 0.2% in September. But go look in the detail table. The unadjusted number is minus 0.1%. So real prices, the real prices that people are paying for cars, are still falling. Main table says that used cars and trucks are plus 0.3%. That's the adjusted number. Go look at the raw data. Used cars and trucks are down 0.1% in September before those seasonal adjustments. Recreational commodities, things like TVs, down 0.2% in September. Pets and pet product category, down 0.4%. Sporting goods, down 0.3% in September. Even the photographic equipment category, which has somehow eluded the whole downward trend and managed to stay high, down 1% in September. Recreational reading materials, things like newspapers and books, down 0.8% in September. The list goes on and on. Transportation services continue to be high. And you can see that insurance is up 1.1% in September with an annual inflation rate of 16.3%. And motor vehicle repair is up 2.8% in September with an annual inflation rate of 6%. The car companies and car insurance companies are absolutely fleecing their customers with insane price increases for no particular reason whatsoever other than operating as a cartel. Well, no reason except for the fact that insurance companies are now making record profits off all of this, but unrelated. I had an issue with my Jeep a month ago. The issue was linked to the car computer, so I couldn't get the local garage to help because only Jeep dealers are allowed to access that computer. The only 2 Jeep dealers that I can reasonably drive to have a waiting list of 6 weeks before they could schedule an appointment. And at that appointment, they would not repair anything, no. They would just connect their diagnostic machine and tell me what's wrong so that then I can book another appointment for another, 6 to 8 weeks later, and that appointment to find out what was wrong would cost me $500. So Stellantis treats their customers like shit, and then they get surprised when their sales numbers completely collapse, they begin issuing profit warnings, and their share price collapses by 55%. This is on top of overall demand for cars being down. The point is, customers are not spending money on new cars or on new TVs or on going on vacation. And because they are not spending their money on any of those things, the prices of those things are falling every single month recently. And at the same time, car insurance companies and the car companies themselves are jacking up prices on car repairs and on the cost of insurance policies to try and make up the difference because nobody wants to buy new cars. People don't have money. The jobless numbers just came in a lot higher than expected, and the media is saying that this is because of Hurricane Helene. But here is the detailed data. North Carolina did see a surge of initial claims up from 2.9 thousand to 11.5 thousand in 1 week. That's a big increase. Florida and Tennessee also had noticeable increases in initial claims. But that's not really the whole story. Look at the traditional manufacturing states in the Rust Belt. Michigan, initial unemployment claims went up almost 10,000 in a week, more than doubled. Indiana, number almost doubled. Ohio, number also almost doubled. And this comes on top of the manufacturing index being in less than 50 negative territory for some time. This suggests that unemployment data is showing something beyond the impact of the hurricane. And this morning, Delta Airlines released their earnings, the first of the big airlines. And their unit revenue is also down year on year in Q3. And that means people are paying less for their tickets. And look, it's down more for Latin America and Pacific, which is where lower income passengers tend to fly more, and is down less for going to Europe. People who have more money to spend typically on those flights. People on low and middle incomes are struggling and are not spending money. In the August data, inflation overall was negative month on month, except shelter. This month, inflation without shelter has ticked up to be just below 1%, but still very, very low. That inflation rate is still much lower than the Fed's 2% target, and it continues to be much lower than that. And shelter is only high at the moment because of this lag effect. Oil price has gone back up in October because of the situation in the Middle East, so when we see the October inflation data, gasoline will not be sitting in minus 4.1% month on month like it was in September. Natural gas continues being at a historically low level, but energy prices are still not coming down since the huge increase in prices 2 years ago. The fact that pretty much every single energy company at the moment is posting record profits is of course again just a complete coincidence. But here's the thing. This is the last inflation report before that next Fed meeting, because the next Fed meeting is happening early in November, before the October inflation data comes out. And Jerome Powell has just come out and said that the Fed plans to make smaller and slower rate cuts going forward after the 0.5% cut last time. So with this inflation data and with this weird sentiment that, oh my God, is really bad, there is a chance that the Fed now will not reduce the rate at all. Now, the FedWatch tool says that futures market is currently betting overwhelmingly on a 25 basis point cut, putting an 87% likelihood on it. But a month before the last meeting, everyone was pretty much dead sure that there was only going to be a 25 basis point cut too. The issue that nobody is talking about is that the current rate is still incredibly restrictive. It is strangling the economy. Relative to the current rate of inflation, there has never been a period where the interest rate stayed so high for so long. If you take into account the lag effect of shelter, the real rate of inflation is much lower. And while the interest rate is high, businesses are continuing to struggle with debt. Investment into those businesses is harder to get. Companies are not hiring. Unemployment in September came in lower again at 4.1%, down 0.1% for the second month in a row. But the long-term optics continue pointing upwards. And if the companies that are now not hiring start actually firing people, that could unravel pretty quickly. The Fed is playing with fire. New data that came out this morning shows that the average weekly hours worked has fallen 0.3% in the last month and is down 0.6% year on year. But when we look at the other report, the employment one, it says that unemployment is down over here. Unemployment is up in September. And if you scroll down, the number of people employed but only part-time is also down slightly too. So this is weird, right? The numbers don't stack up. The number of hours worked per week is going down, but apparently people are not losing their jobs, more people are getting jobs, and less people are working part-time. So the number of hours worked is now dropping despite all of that happening. And that's kind of interesting. It suggests that companies are cutting back on overtime, cutting back on official overtime or the hours that they employ full-time employees for. Companies are cutting down the number of hours for full-time staff, and this may mean that productivity of those companies may begin going down and being reduced in future reports. At the moment, these are pretty small movements, but it's unusual for the number of weekly hours worked to go down without either unemployment or part-time work increasing at the same time. The detailed data is not really showing us much as to why this is happening. Overtime in manufacturing is down a tiny bit, and there's a few sectors where hours are down too, but not a single sector in there is showing any particularly big downward movements. The issue is that every month that the rate continues sitting substantially higher than inflation, the suppression of demand gets worse. People's difficulty with spending money gets worse. Companies are feeling the pinch more. And at some point, those companies can start cutting back on staff. Inflation is already sitting at pretty much 0%. So if unemployment starts ticking up, those people losing their jobs will see their spending power drop, and that can send inflation flying into negative territory very quickly. And if the Fed does not do anything at the November meeting, the next meeting after that is just before Christmas, the last meeting of the year. And there will be 2 more inflation reads before that meeting. At the moment, inflation is at 2.4%, but the upper end of the interest rate range is still at 5%, more than double, and that is nuts. If that interest rate does not go down or only goes down 0.25% at this coming meeting, then inflation will have 2 more months to see shelter move down, and we'll see 2 more months of employment data. And if that data suddenly begins tipping the wrong way, I am not sure what the Fed is going to be able to do, because cutting rates by more than 0.5 percentage point at that point will be taken as complete disaster, right? Cutting by more than 0.25% will be taken as panic. But remember that election is also just around the corner, and that can turn things in a very different direction if sudden changes are brought in. So I guess let's see what happens.